everyone for joining us today. Yes, it's quite chilly here in Cape Town, and I believe in other places like Shane you mentioned. Hopefully everyone is keeping warm and that you enjoy the session this morning. For those of you who attended our webinar last month, you might have remembered that Monique spoke about various accounting concepts and mentioned or introduced the difference between the accounting frameworks. Today, we are going to follow on from those concepts. So some of the things that I speak about might be a bit familiar to you, but for others, we are going to cover them again to make sure that you're all on the same page. I will also be shifting around between different pages quite a bit, and when we are in the financial statements from page to page. So please, if you are struggling to follow or you might be left behind, just I think there is a function where you can put up your hand or maybe type a question to say please go back, and I will be more than happy to make sure that we're all following where we are. Now, recently I had a business owner comment to me that he didn't really use his annual financial statements at all because he didn't get a lot of information out of them. He's more concerned about his cash flow in his business, and this whole pack of papers is really for him kind of a little bit of a need to do annually, but it doesn't really give him any help. And so hopefully if you feel something similar to that, today's session can give you a little bit more comfort as to what your financial statements are actually telling you and how you can use them in your business to make more effective decisions. I'm going to go right back to the beginning and look at the financial reporting frameworks. And Monique did touch on this in our previous webinar last month. But today we're going to look at it in a little bit more detail. What is a financial reporting framework? It is the set of guidelines used in the preparation of financial statements. So it's almost like the instruction manual for your financial statements. It's principle-based. In other words, it relies on the integrity and competence of management and directors. And throughout today's presentation, if I talk about directors of companies, I also include members of closed corporations. And it's then the reliance on this integrity and competence of directors or management to make significant judgments and estimates as part of your financial reporting framework. Now, your choice as to which framework to use, because there are a few different ones, is typically based on the type of your business, the objective of the financial statements. In other words, what are you going to use them for? Who will be looking at them? What type of decisions do you need to make? As well as the applicable laws and regulations to your specific business. And you might ask, but why do we need a financial reporting framework? Can we not just create financial statements and prepare them any way we want to? I mean, we can bring in our income and our expenses, and I mean, we can do whatever we want. Surely it's our business. But it's important really to follow this reporting framework, especially from an accounting point of view. Why? Because it provides useful information to the users of financial statements. And we are looking at, when we talk about useful information and the users, who could this be? We're talking about lenders, in other words, financing houses, possibly like banks, who you might approach as a business owner to get financing from. It could be creditors that you would like to include in your supply chain, or it could be if you maybe were a business and you want to obtain new customers. So you can see that the useful information in your financial statements needs to be from the perspective of various different users. And by using a standardized financial reporting framework, you are actually able to do this. It also provides information about the cash flows to which your business is subjected, including the timing and uncertainty of cash flows. And this is critical for determining the liquidity of the business. In other words, are you able to pay your debts as they become due? And this then links to whether your organization can continue as a going concern. And we will touch on these concepts a little bit later in the presentation for those of you who are not familiar with the going concern concept. The financial reporting framework also allows you to disclose the obligations or liabilities, as well as the economic resources or assets of an entity. And it's important also that there needs to be an emphasis on the movements in these items. So the movements or changes in your liabilities and the changes in your assets, because this can enable the users of financials or anyone who reads your financials to predict future cash flows of your business. It also allows for comparability of your financial statements. So if you use a standardized, consistent financial reporting framework from one business to the next, it will naturally allow those financial statements to be comparable because you are using the same principles and guidelines to prepare your financial statements. And it also improves the efficiency of business across borders. So if you are using a financial reporting framework that is internationally recognized, then you could actually do business overseas possibly a little bit easier, because if you have financial statements that they might, or someone overseas that you need to transact with might want to view, the moment they see, oh, you're using a financial reporting framework that they know as well, then they can actually communicate and read your financials a lot better. Your financial statements are also used for tax purposes. And naturally, I think SARS would prefer to see a standardized financial reporting framework being used rather than something personal to the business, because for them, it obviously relates to compliance of that business with regards to the tax legislation. So the two accounting frameworks or financial reporting frameworks that I'm going to touch on today is your tax-based accounting and your IFRS for SMEs, which is the International Financial Reporting Standards for small and medium-sized entities. Now, the reason we are looking at these two today, Monique touched on them last in our previous webinar in terms of an introduction, is because these are the ones that were mainly used in your small, medium, and micro-sized entities, which would be applicable to business owners with regards to our webinar today. We're also going to have a look at them in a little bit more detail to make sure that you understand how these are different. Now, the tax-based accounting framework is usually based on historical cost. So as the transactions occur, they would be recorded in the books. In most cases, the profit or loss that you calculate in your financial statements or in your income statement will equal to your taxable profit and loss, because you are actually creating these financial statements based on your tax principles. However, there will be permanent differences. And when I talk about permanent differences, let me give you a few examples. Say you made a donation to a charity, but you didn't receive an official tax certificate, a Section 18 Cap A tax certificate. In your financial statements, in your income statement, you can deduct that donation as an expense. But from a tax or SARS point of view, you cannot use that as a deduction in your tax calculation because you don't have the supporting tax certificate. And in that case, it will be a permanent difference, because for tax purposes, you'll have to add it back. Or another example would be, for example, dividend income. If your business receives dividend income, it would be income on your side. However, for tax purposes, in most cases, dividend income is exempt from tax, so you would have to exclude it from your taxable income, and it would create a permanent difference. So in most cases, tax-based accounting looks at the same steps or the same principles as your tax, except for these permanent differences that could arise. In contrast to that, when we look at IFRS for SMEs, this framework is based on the principles of fair value. Now, what is fair value? To give you a bit of a definition, it is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction when between market participants at the measurement date. So you can see that there's an emphasis on an orderly transaction and market participants. So the feeling that you get is that your fair value could be related to the market value. So it's a more current value than your historical cost. When you calculate your profit or loss, it won't equal your taxable profit and loss because of these adjustments that IFRS for SMEs requires you to make to get to the fair value of certain items. So your fair value is rational, it's unbiased, it's the potential estimate of a market price of a good, service, or an asset. And it takes into account a few things, like for example, replacement cost, or similar products, goods, or services. So market-related issues. What IFRS for SMEs then does is it attempts to reflect your financial statements at a more current or real-time value, as far as it obviously can, because financial statements are, in essence, a historical view of the financial year that is already passed. They are trying, or the International Financial Reporting Board is trying to bring your financials into a more current view so that the users or those who are reading your financial statements can make better decisions based on future changes or future things that might happen in your business. So the tricky part sometimes is to determine the fair value of certain assets or liabilities at your end, because it might be that you have a very specialized piece of equipment. Say it was a manufacturing machine that you had that was made especially for your business. That won't have an active market. I mean, it won't be something that is bought or sold in a market every day. So to determine a fair value for that asset could be quite tricky. And in that case, IFRS for SMEs does give leniency to the smaller business owner because it does take a lot of effort and cost to determine specialized fair values. IFRS for SMEs therefore also requires management to take accountability and responsibility for certain policy choices, estimates, judgments that need to be made. Because you'll see later on in our presentation, when we talk about the accounting policies, management or the directors need to be really involved in these decisions, and therefore they need to take responsibility for those. Let's look at a few specific examples just to illustrate the principle and help you to understand the difference between tax-based accounting and IFRS for SMEs. Let's look at property, plant and equipment. From a tax point of view, you would get your wear and tear allowance under Section 11E based on your schedules that you get from SARS. It gives a number of years wear and tear that you can claim on certain assets. So those are per legislation. However, if you look at the IFRS for SMEs framework, we talk about something called depreciation, which in essence is the same, and a lot of people use these two terms interchangeably. But this depreciation under IFRS for SMEs is basically determined by estimating the useful life of your asset. In other words, how long can I use this asset and gain benefit from it? At what value will it be at the end of its useful life, which is its residual value, and then taking that into account to determine how much you are going to write off in depreciation or value loss every year. So you can see it's very different to tax-based because you might have an asset that gets written off or can be used for 5 years, whereas under your SARS legislated schedules, you can only write it off under 3 years. So you can see that there's immediately a difference. Investment property. If you purchased a property, say, for capital appreciation or to earn rental income, from a tax point of view, that wouldn't really have an effect until you sell that property, and then you might probably have a capital gain on it. Whereas under IFRS for SMEs, if you can fair value or value that property every year, and it doesn't take too much cost or effort, then you are required to actually show it at fair value. And in most cases, you would probably have a fair value gain on property because property tends to appreciate in value over time. So you can see that there is an accounting adjustment that goes through your profit and loss because of the accounting policy required by IFRS for SMEs to fair value your investment property. Similarly, if you have a mortgage bond, on a tax-based accounting, you would most probably show the historical cost of the mortgage bond as well as the payments as they go off every month as an expense. Whereas under IFRS for SMEs, you're required to look at a calculation of amortized cost, which basically looks at how this mortgage bond unwinds over time with regards to the original capital amount, less amounts of capital that you repay, interest that gets accrued and repaid as well, and bringing that into account to get a year-end value. So you can see it is very different to your tax-based accounting. It also creates a lot more room, not necessarily for error, but in terms of making sure that you are accounting for things correctly. Office rental payments. From tax-based point of view, if you have rental payments, you would put them through as an expense, early of invoice or payment. Whereas under IFRS for SMEs, if your rental payments per your contract have an escalation clause, in other words, they increase every year, that is not in line with general inflation, then you're required to straight line those payments. In other words, you take the term of the lease, you take the total amount of payments over that term, you divide it by the number of years, and that would be the amount that you would, or the number of months, say, that would be the amount that you expense as an even amount or even expense per month or per year on that lease. And that is purely that if you have large non-market related fluctuations, it doesn't affect your profit and loss. And let's look at, for example, salary bonuses. You might have employment contracts that create an obligation in your business or liability to pay bonuses to certain employees. Tax-based accounting, you will expense it most probably when you pay those. Whereas IFRS for SME says that if you have a provision, if you have an obligation to make that payment, you can raise a provision or a liability for that. And then when that actually gets paid, it gets written off against that provision. In other words, the expense goes through in the year where that obligation is created and not necessarily the year in which it is paid. So you can see that is also very different. And from a tax point of view, tax-based accounting, you would do your tax calculation as normal and then reflect the tax per your SARS legislation. Under IFRS for SMEs, you would do exactly the same, but you would also bring in something called deferred tax. And I think possibly the majority of you might have heard of deferred tax. It might create a feeling of dread among some of you, but deferred tax is essentially the IFRS for SMEs framework trying to bring in a forward-looking view of the tax effects of the items on your balance sheet. So it's basically trying to bring in, as I mentioned earlier, a more reflective view of your financial statements. In other words, what will be the tax on these items in my balance sheet in future, and how will that affect my cash flows in future so that I can make effective and good business decisions today. And that is what deferred tax essentially is. Later on, when we go and look at the financial statements practically, I will work through an example that might look familiar to you because Monique introduced it in our previous webinar, but I will also be looking at a few extracts just to illustrate these principles that we've just spoken about. Let's jump right into practical examples. First of all, let's start off with the sole proprietor. Now, in most cases, your tax base of accounting you would use if you're a sole proprietor. If you have a very small business that you are not expecting to use those financial statements to take to, say, a bank for financing or anything like that. So it's more simplified, it's more cost effective, and you obviously don't have a lot of users. It will mainly just be you as the business owner or the shareholders, depending on your business structure. Let us have a look at an example of the income statement and the statement of personal assets and liabilities of a sole proprietor. Okay, this schedule might look familiar to some of you. Here we've got Joe Bloggs trading as ABC Services. He's a sole proprietor, and here is his income statement for 2018. You can see it is very straightforward. Fees received income, expenses as they occurred during the year, which gives you net income at the end of the year. In this case, I don't see a major difference in terms of tax and this accounting's income statement because there aren't any permanent differences specifically. So this net income in most probably will be his taxable income, unless there's information that is not reflected on this worksheet. If we look at his statement of personal assets and liabilities, you will see that it's basically a list and mainly at historical cost of your assets, both the business and personal, because remember, SARS doesn't see a sole proprietor and his business as two separate entities. The sole proprietor and the business related to that sole proprietor is seen as one individual or one legal entity. So we'd bring in your personal assets and liabilities here as well. At the bottom, you'll see in this case he doesn't have any liabilities, but if there were any, that would be used to calculate the net assets. And that is as simple as the tax base of accounting is. It's very straightforward, based on the transactions as they occur and mainly in line with the tax treatment thereof. Let's go and look at a company's financial statements. And here we are specifically looking at the application of IFRS for SMEs. And here is where a lot of detail now comes in, because you'll see as I go through it how much emphasis is being placed on adjustments that need to be made for accounting purposes. Now, when we start off with this company, I'd like you to just understand that most financial statements follow a similar format and order of layout. So it's a nice way to familiarize yourself with that so that you know where to find information as you work through the financial statements. So usually it starts off with an index, or sorry, a cover page, and then an index and some management information, and then it flows into the financial statement reports or your sign-off reports, the director's report and the responsibility of the directors, and then into your actual figures, so statement of financial position, statement of comprehensive income, statement of changes in equity, and statement of cash flows. And then at the end, you'll find your accounting policies and the notes or the additional information to those financial statements. And in some cases, you might even have extra information, like a tax calculation or a detailed income statement, depending on the format of that specific financial statement. So what we're going to do today is I'm going to run you through some of the important points and things to look out in your financial statements to make them easier to read, and how you can use that going forward to make better decisions in your business. The first thing that I always like to look at is to see which accounting framework is being used in these financials. And I'm going to show you where to find that. you look at your financial statements and you page right the way back to your accounting policies, you'll see here we start with the accounting policies. You'll see that there's a summary of significant accounting policies, general information. And usually right at the beginning here, it says which financial statement framework or which accounting framework is being used. So in this case, the annual financial statements have been prepared in accordance with the International Financial Reporting Standards for small and medium-sized entities. So it's your IFRS for SMEs. And that immediately puts your financial statements into context. It already allows you to create expectations as to what I think I should see in the financials. And if I don't see them, then it allows you to ask questions as to why or what else I need to then look at. So that's a nice way to put it into context. From there on, going right to the beginning, there was your cover page and your index and some general information in terms of your nature of business, your directors, who the independent reviewer in this case was, your shareholders. We start and we look at the financial statement reports. Now, before I delve into this practical example, I just want to show you or explain to you the differences between the different reports that you can get. Now, the first report we're going to look at is a compilation report. Now, a compilation does not include or does not involve an audit or review. In other words, no assurance or no opinion is provided on the financial statements. However, it does provide an implied assurance about the fair presentation and relevance of the financial statements, because that's required by your accounting standards or your financial reporting framework, as well as the procedures prescribed in terms of ISRS 4410, which is the standard that governs or prescribes or sets out the responsibilities of the compiler. The person who compiles your financial statements usually is an accountant or a professional who knows accounting standards and knows or has the required technical skills to perform this compilation, because they need to exercise independence as well as integrity, as well as compliance to the accounting standards themselves. A compilation is not merely taking information and setting up or preparing your financial statements. It involves additional work to that as well. Preparation of working papers, documenting evidence that you acquired or that you gathered as part of your procedures, and compiling these financial statements to make sure that when you sign off as the compiler, that you are representing a fair view of those financial statements based on the information that you received. In this instance, and because of that, the concept of materiality is introduced. Now, what is materiality? In a nutshell, materiality is usually a rand value above which, so say for example, so it's almost like a threshold. And if there are any errors or misstatements above that threshold, it would cause anyone who reads these financial statements to change the decision that they were going to make. So if you, for example, have someone who wants to give this business finance, and there might have been an error, say of R1 million in the financial statements, in your revenue, and that R1 million is 90% of your total revenue figure. Surely that would change that bank's decision in terms of giving you finance, because there's such a large error in your revenue. So you can see materiality is very often quantitative. It's valued in terms of an amount. But just remember that materiality can also be qualitative. For example, it might just be a R100 error, but it could be because of theft or fraud, and that would make it just as material or just as important. Apologies, I seem to have, there is an expression, an opinion being expressed on those financial statements. It's negative assurance. In other words, if you read the report, you'll see that it says there is no or nothing that has come to our attention that shows that these financial statements in all material aspects do not comply with the accounting framework. So once again, the independent reviewer needs to be independent, needs to act with integrity and compliance, in compliance with the accounting standards. And an independent review assesses the financial statement risk. The independent reviewer applies professional judgment, skepticism, does analytical procedures and inquiries, and obtains evidence for those items that have material risks. And then, based on that, the independent reviewer then expresses an opinion. Often, an independent review is used for or prepared by private companies due to requirements of outside parties, for example, banks, creditors, investors, because they need to have comfort that the financial statements are not materially misstated, and an independent review is a way to do that. Further on is an audit. So you can see we're going up in the chain, where an audit provides reasonable or positive assurance. In other words, these financial statements in all material aspects are a true and fair reflection of what happened in that business. An audit must be performed by a registered auditor and must comply with certain standards. And there are certain procedures that are performed on the amounts disclosed in the financial statements. So these procedures are designed to identify material misstatements. It regularly involves testing a sample of transactions and balances. And it also includes a detailed review of the financial statements, including the disclosures, to ensure that they comply with the accounting standards or the financial reporting framework, as well as company law and legislation. Once again, materiality is very important in an audit. As you can imagine, an audit will obviously be more costly. Now, all three of these reports, a compilation, an independent review, and an audit, are important to understand and to note whether there are any matters that come to the attention of the reviewer or the auditor in these financial statements, because that immediately allows you to focus your attention when you are reading the financial statements. And now I'm going to jump right back into our practical example to show you how this works. So here we've got the independent reviewer's report. It basically sets out what the independent reviewer has done, who the responsibilities are. And here at the bottom on the conclusion, it says, based on this review, nothing has come to my attention that causes me to believe that these financial statements do not present fairly in all material respects the financial position of the company. So you can see here it's negative assurance, it's limited assurance, but there are no issues raised. And I want you please to just keep this in mind when we go forward, because it's something that I'm going to refer back to. So remember, there were no issues. This is an unqualified report. If, however, there was a qualification on this report or an emphasis of matter or something that was highlighted, then obviously it will be a red flag that you need to note. And the users or whoever's reading these financial statements, like the banks or credit providers, they will be very interested to see if there are any issues raised in these reports. So obviously the best thing that you want is an unqualified report. I'm going to jump right down through these financial statements to your balance sheet or statement of financial position. The first thing I want to look at is this equity section down here. Now, your equity is an indication of the value add in your business and how much value you have grown over the years of being in business. And in this case, you can see they've got an accumulated loss. In other words, that's negative. It's not usually a good sign. However, we need further investigation before we can decide, oops, there are problems in this company. So based on this negative value, shall I say, or negative equity or the accumulated loss, I want to flip back to the director's report, which is basically the next thing that I always like looking at in financial statements, because it summarizes or sets out key highlights in these financial statements. So the director's report often talks about things like, were there events after the reporting date? Were there any dividends that were declared? What about changes in shareholders? Changes in issuing of shares? Anything like that, interest in contracts by the directors. And those are important things to take into account when you read the financials and are going to make decisions based on them. The one thing I want to kind of stop on here today is the going concern. Now you can see here in this director's report, there's an emphasis being placed on the going concern of the company. These financial statements have been prepared on the going concern basis, despite showing negative equity, as I've just showed you, as well as a loss for the year in the income statement. I'll show you that in a few slides on. And what this basically is saying is there are certain reasons that they've made losses. You can see here, mainly due to higher expenditure on research and development costs, because they are in the setup stages of the entity. So you would think, okay, well, if you're a startup, it makes sense that you're making losses and possibly need more help in the beginning than you would later on when you're up and running and everything is going smoothly. But I'd like to show you why these financial statements can still be prepared on the going concern basis and why there is no qualification in the independent reviewer's report because of this. But before I can do that, I just need to explain to you what the going concern concept is, for those of you who might not be sure. Now, going concern is a fundamental principle of accounting. It assumes that the entity is able to continue operations in the foreseeable future, In other words, during the next financial year and beyond that, the company will complete its plans, it will use its assets, and it will continue to meet any liabilities or financial obligations that it has. So immediately you can see it links to liquidity and solvency. Are you liquid? Can you pay your debts as they become due? Or are you solvent? In other words, do your assets exceed your liabilities? Now, in this case, we can look at two cases of solvency. We can look at technical or factual solvency, where your liabilities exceed your assets, which is the case in these financial statements as I've shown you. This is not necessarily a going concern problem, and I'll show you why not. Whereas commercial insolvency links to your liquidity, where your debts, you cannot pay your debts as they become due, and that is definitely a going concern problem. So you can see the going concern becomes important when we look at the financial statements because it determines how you are going to present these financial statements. It's not a very good sign for investors if your going concern is in doubt, because obviously you wouldn't want to invest in a company that is not expecting to be in business in future. So the going concern basis, your financial statements, you can actually then create or apply certain principles. So for example, prepayments. If you pay an expense now, but it'll only really become an actual expense next year, so it's a prepayment for something, you can recognize that in your financial statements, and then when the expense actually occurs or it's incurred, you can write it off against your prepayment. That assumes that you're going to be in business next year where the payment becomes due or the expense accrues. The same with accrual of expenses. If you accrue expenses this year that you know you're going to pay next year, you are assuming that you're going to be in business next year. The same with depreciation of assets based on useful life. You're expecting that you're going to be in business over the useful life of that asset. And that is how the going concern principle is applied. If you don't use the going concern principle, in other words, you are not expecting to be in business in future, then you would need to prepare your financial statements on a liquidation or realization basis. And with that, you would have to bring in certain consequential costs and losses in terms of liquidating the company. And obviously, that's not a good sign for shareholders or for any users of the financial statements. So to just give you an example, XYZ Pty Limited is unable to make payments to its creditors due to a very weak liquidity position. In other words, they can't make payments. The court grants a liquidation order upon the request of one of the company's creditors. The company is therefore no longer a going concern because there is sufficient evidence, in other words, the court order, that is available to believe that that company cannot continue its operations in future. It will have to be liquidated because of that court order. Now, I'd like to take you back to the practical example that we were just looking at to see why we do not have a going concern problem in these financial statements. If you page down to our equity where we were just now, we can see that our liabilities did exceed our assets because we have negative value over here or negative equity. However, if you go down to this section here, your liabilities, your major liabilities are a loan from shareholder and a loan from a related party, which would be part of your startup of your company in terms of the capital required to start it, because we already read that in our director's report. If you look at these notes, they're notes 7 and 8. Just going to page down to those. You will see that in the financial statements there has been disclosed that there is a loan agreement subsequent to year end, that this shareholder loan will not be repayable unless the liquidity and solvency of the company is taken into account, which is very important. So it immediately shows that this loan will not affect your solvency because it's not going to be payable on demand. And if you look at the loan from a related party, it says here that there is a subordination agreement. It has been subordinated in favor of other creditors. In other words, it stands at the back of the line so that if anything needs to be paid out on a potential liquidation, the other creditors would come first. And in that case, it doesn't affect your solvency or liquidity either because you would obviously pay your normal creditors first. And this is why, because of these two agreements, the subordination agreement and the loan agreement, which takes into account liquidity and solvency position first, the independent reviewer can actually sign off this report and say that there are no going concern issues because those specific loans that create this assets less than liabilities position in the financial statements when the balance sheet won't actually affect the business's ability to continue as a going concern or to trade in future. So that's an important thing to note. The moment you see negative equity, go and investigate further and see, is this going to be a real problem or not? Then I'd like to go back to the financial statements and just work through them and highlight a few key points that are important to remember or to note when you're reading the financial statements. You can see that in the statement of financial position, you have note numbers, and these note numbers reflect the additional disclosure or extra information given in the financial statements. And it's always a good idea to read your line items in conjunction with these notes, because that's where you get all the meaty part of your financial statements. Now, before I jump through to your notes, and in terms of that, I'd like to go down to your accounting policies, because this is where it describes how your financial statements have been prepared. And it links to how important it is for your directors and management to have input and value add in terms of choosing your accounting policies and making sure that the professional judgment is being made. Let's give you an example of that. I want to look at property, plant, and equipment. In this case, property, plant, and equipment says that the policy that the company is applying is that they are measured at cost less accumulated depreciation and any accumulated impairment losses. So you can see we are looking at the cost model in this case. IFRS for SMEs gives you the choice, either use cost model or revaluation model. In other words, if you can determine the market value of property, plant, equipment at year end, rather show it at the revalued or current market value. In this case, they chose to use cost model, and that is what this accounting policy reflects. And then obviously also your depreciation rates, where management had to have made an estimate as to how long they can use and obtain economic benefits from the different categories of PPE. So what are the useful lives? And that would determine your depreciation rate. So you can see just from this one example how important it is to understand your accounting policy and how that then flows into the financial statements, because your accounting policy tells you, okay, PPE is at cost less depreciation and impairment losses. So what do you expect to see? You expect to see in your financial statements your property, plant, equipment at cost. You're expecting to see a depreciation amount, potential impairments if those are the case, and then you're obviously going to get a carrying amount at year end. If this policy had stated that they're carrying their property, plant, equipment at revalued amount, you would have expected to see a revaluation amount going through, which lies under your equity, as well as that amount being reflected in your PPE. So it's completely different. And that is why it's important to understand your accounting policies, because those are your building blocks as to how your financial statements are prepared. I want to jump back to your statement of financial position. In the old days, it was called the balance sheet. So there we had a look at your property, plant, and equipment. And what I just want to highlight here is that at the top here under your assets, these current assets, if you look at these in conjunction with your current liabilities, in this case, your trade and other payables, that is usually or typically known as your working capital cycle. And right at the end, I'll explain as to how we can use that going forward. But it's always good to keep in mind what's going on in terms of your working capital, because that reflects very much your operations of your company. In other words, do I have cash that's being locked into my trade receivables? How long does it take for my trade receivables to pay me? Do I have a large amount at year end, or do I expect that to be recovered close after year end, or is that going to lie there for a long time? Do I have surplus cash? Can I invest that? What can I use that for? Am I holding it back or keeping it because I know I want to invest in an asset after year end? And the same on the converse side for your payables. Am I utilizing this efficiently? In other words, am I taking the maximum amount to pay my suppliers that they are giving me credit for, so that I can use that money for my business? So it's just things like that that you can start thinking about when you're looking at your financial statements. The liability side here at the bottom is where your, as I mentioned when we talked about going concern, your solvency and liquidity issues come up. And this is very important because under the New Companies Act legislation, the directors are held responsible to determine the solvency and liquidity of the company in various instances of decision making. In other words, before taking on new debt or similar transactions, they need to determine and document that the company was liquid and solvent at that point. And that is where this section of the statement of financial position comes in. It also shows you what the sources of financing are. In other words, what is the leverage of the company? Do you merely have debt, in other words, these loans, or did you have a large share capital? Do you have a large share capital, in other words, that you have equity that finances the business? And that ratio between loan, capital, or debt and your equity is called the leverage of the company. And that could very often indicate to the users of financial statements whether you can actually repay your debt going forward. In other words, if your debt portion is very large, say more than 40 to 50%, that could be potentially a red flag. Can the business handle or service its debt in terms of how it has been structured? So that's something interesting or important to keep in mind. Moving on to your statement of comprehensive income, what we typically look at here are measurements such as your gross profit margin. And typically you would like to see a trend in your gross profit margin because that will show how your business is reacting to market conditions. It also speaks to the profitability of the company in future in terms of what transactions are going to happen. And it is typically here that you will see a lot of the accounting or fair value adjustments going through that IFRS for SME requires that is different to your tax-based accounting framework. And in one of the extracts later, I'll show you an example of that. At the bottom here, you'll see there's finance income, but typically the finance costs could also be kept it's something that you can keep an eye on because that will talk directly to your level of debt and whether you can actually service that debt as through your ordinary operations. Your statement of changes in equity is basically your transactions with your owners or your shareholders. So typically here you would see things like your profit and loss for the year, any new issues of share capital, any dividends paid, and that would give you your equity. That is a result of how you are taking your assets and applying them in your business. And then I'd like to spend a little bit of time on the cash flow statement because this is quite important. This is where that familiar phrase cash is king is actually applied. And I think this is one of the most misunderstood parts of the financial statements, but this is really where your cash flows are shown in your financial statements. So you'll see it's split into three portions: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. So basically it's talking about how did my cash work for me in terms of my day-to-day operations? What did I use that cash for? And where did I get cash if it wasn't categories? Now, the operating activities, you would preferably want to see it as a positive cash flow. Sometimes it could be a negative cash flow, but if you have a trend of negative cash flow in your operating activities, that could be a major red flag because that means your day-to-day business is making losses in terms of cash. So you can't really even blame it on accounting adjustments or anything like that. This is purely cash. So what we basically look at the top here is where you usually start off with your accounting profit or loss. You need to adjust back everything that is non-cash. So if there were any fair value adjustments, any depreciation, because that's mostly an accounting entry, any interest that was paid or received that is non-cash, that you would all add back. You would look at any movements that are only cash related in your working capital. So that would be your trade receivables, your payables, any provisions or short-term loans. And that cash movement would then be the cash that you receive or expend in your operations. If you look at this short-term loans, I want to just show you quickly in the statement of financial position. That would basically be these two loans, the shareholder loan and the loans from related parties, which we then look at the movement from prior year to current year. So you can see that there was a new loan that was raised from the shareholder this year. So it was additional financing. So that was cash inflow. And you can see that some of this cash was, some of this loan was repaid in terms of this related party loan. And because if you look at the notes, there was no interest on any of these loans, you can assume that this was purely cash flow. So the net effect of this inflow and that outflow will be what you see here in your statement of cash flows as being inflow in your working capital because it's financing that you received from the shareholder. Same when we look at the trade receivables. In this case, it was an outflow because we had an increase in our receivables. There you would look at things, for example, like bad debts that are non-cash. If you had a bad debt that was written off or raised, you would add that back because that's not a cash flow in terms of receivables or customers paying you. Because your customers increased, we're showing it as an outflow because it's cash that's being stuck in there. They're not really going to pay us this year. We're only going to get the cash possibly in future. And then trade and other receivables, that increased, so it's an inflow because we are saying we are actually receiving that credit to use and we only have to pay them at a later stage. So it's something that we can then use in terms of our working capital. If we look at our investing activities, you can see, and this links directly to your property, plant and equipment note, you can see that we spent about 500,000 Rand, or this company spent 500,000 Rand on property, plant and equipment that they acquired for that year. So if you go to note 3, I'm going to quickly page there, you'll see, if you look at the summary of additions in that note for this year, that is the amount that was spent in cash on your assets. So it's the amount that has been invested that year into the business. Financing activities. Here we looked at some share capital that was issued in the prior year because it is a new startup company. Nothing happened in terms of share capital this year. But now what I just want to highlight is we did receive financing with regards to the shareholder loan, but this is sitting up here because it's short-term in nature. You could have also, if you wanted to make it presented differently, you could have put these short-term loans down here under financing, but in essence, it's going to be the same thing because it's working capital, it's short-term, so this usually looks at more long-term financing. And all these cash movements will then show how you get to your end bank balance. It's important that you understand or keep an eye on these cash flow movements because that could indicate what direction your business is going in future. The other thing I want to highlight on the financial statements before I look at a few specific extracts is right at the bottom is this thing that they call related party transactions. Now, this is a note that is specific to IFRS for SMEs. It's required by the accounting or financial reporting framework. And it might be something strange to some of the business owners because it basically looks at related parties to the company, and IFRS for SMEs is quite specific as to who will be considered related parties. But that would be, for example, shareholders, key management like the directors, any entities under common control of any of those related parties. If you are in a group of companies, it would be your subsidiaries or your fellow subsidiaries. So those are the types of related parties that you can get in a very brief nutshell. But IFRS for SMEs requires you to disclose any transactions as well as balances with those related parties at year end. And this has become increasingly important, especially with the recent Steinhoff saga, to disclose these related party transactions because in most cases, it's not to say that it always happens, but there could be an instance where you might enter into a transaction with your shareholder that is not at market conditions. Let's say, for example, the shareholder extends you a loan. The loan is interest-free and there are no repayment terms. That doesn't necessarily reflect market conditions because if you went to a bank for the same loan, they would have charged you interest on that and they would have given you a very specific repayment schedule. And that is why it's important to disclose related party transactions because that would give you an indication of what's going on in the business that is possibly not market related and what you need to be aware of as a user of the financial statements that could affect this business. Once again, you can see also here at the bottom, there is disclosure or emphasis on the going concern concept again, where we said that there is potentially a going concern problem because liabilities exceed assets and losses are being made. However, it doesn't reflect an overall problem on the business. The business can still function in the future because of the agreements in place and because we are expecting from a startup company that we will have a little bit of kind of struggle startup phase right at the beginning. I'd like to jump now to a few examples or specific extracts that are not shown in the financial statements I've just shown you, just to emphasize a few additional points. So here we have a statement of financial position and an extract which shows you deferred tax. So you'll see your deferred tax usually falls under your non-current assets or liabilities. In this case, we have deferred tax asset. And if you go and look at the note to that deferred tax, you'll see it shows what are the movements during the year, what it is made up of, and which portion is the liability and which the asset. Now in this extract, it has been shown on a net basis. You can also split it in your financial statements. But I just want to explain this portion to you here. How did the deferred tax asset arise? Just to put in a little bit of context. Previously, right at the beginning of the presentation, I mentioned that deferred tax is an attempt to show the future tax effects of items in your statement of financial position currently, just to give a more comprehensive view of what is going to happen in this business in future. So if we look at this extract, there were provisions in the balance sheet as well as prepaid expenditure. Now, what is a provision for? To just explain it a little bit more clearly. A provision is a present obligation that needs to be paid, but you only expect to pay it in future. There is, however, a present obligation. So either by way of contract, say, for example, your salary bonuses, you know you will have to pay it. You can't get out of it, but you will only pay it in future. And then IFRS for SMEs allows you to raise a provision and put the expense through in your books this year when the obligation was raised, rather than only when it was expensed or paid in cash. So what does this mean? For accounting purposes, we are raising the provision currently. So it's going through as an expense in your income statement or your statement of comprehensive income. And it's lying on your balance sheet as a liability because it's an obligation of the company. However, what happens for tax purposes? SARS will only recognize this payment as a deduction once the expense is incurred or paid, which is in future. So that is why you can create a deferred tax asset, because in future, you will get a tax deduction when you actually pay this expense, whereas for accounting purposes, you have taken the knock already. So that just gives you a kind of an overview or a brief understanding of what IFRS for SMEs is trying to do with regards to putting deferred tax into your financial statements. And hopefully that makes your understanding a little bit clearer as to why it's there. So that is one of the extracts I wanted to show you just to highlight kind of the rationale behind deferred tax. This next extract is from the Statement of Comprehensive Income. It's a little bit more extended from our previous one. You'll see here the three things I want to highlight is other gains and losses, your finance costs, as well as this other comprehensive income net of tax. So previously I mentioned that your finance cost is something to keep an eye on because that could talk or link directly to your ability to service your debts as they become due, depending on what your balance or how your balance sheet is structured. But I'd like to start off here with other gains and losses. Now, this is one of those line items that you can immediately see is an accounting entry. It's due to IFRS for SMEs. And if you go into the note 19, you can see it is made up on the gain or loss on disposal of assets. So that would be if you sell an asset, and other fair value gains or losses, which is typically your accounting adjustments. So that could be potentially an investment property that you wrote up to fair value at year end, and that fair value gain or loss then comes through into the income statement. So it's just to show you how that would then be presented in the financial statements and how you would then look out for that. This bottom part here, other comprehensive income, is something I just also want to explain because I think there might be quite a few questions around this. Why is our income statement now called Statement of Comprehensive Income? Because that's a new term that was brought in recently. It is called the Statement of Comprehensive Income because IFRS for SMEs has now tried to split between transactions that relate to the business and transactions with owners of the company. So transactions with owners of the company, as I mentioned earlier, will fall into your Statement of Comprehensive, your Statement of Changes in Equity. So that will be all transactions like dividends, share issues, and the profit and loss for the year that goes to your owners. Whereas the Statement of Comprehensive Income looks at what happens in the business. So, okay, so hopefully every Statement of Comprehensive Income is now split into two parts. So at the top here, we've got our profit and loss, which was our normal income statement, I think, as most of you know. And at the bottom part here, we've got this other comprehensive income net of tax. Now, in most cases, this will be zero to get your total comprehensive income. But when you do see items here, this is basically things that would originally have gone through to equity, but are now reflected under other comprehensive income. For example, if you chose as your accounting policy to take your PPE at a revalued amount instead of at historical cost or cost less depreciation, and to measure them at revalued amount, any revaluations will then fall here under other comprehensive income, because those would normally fall under equity. So it's just to illustrate, if you do see something here underneath your financial, your income statement or profit and loss portion, what that is. I just also want to highlight something that you might be or might have seen in your financial statements, but might not have known what that relates to. And this is as part of your income tax note, your current tax note, and it's this tax rate reconciliation. And what this basically is, it's a reconciliation between your normal tax rate of 28% and your effective tax rate in the financial statements. And it is normally permanent differences like non-deductible expenses, non-taxable income, or any accounting adjustments that will not be adjusted for tax purposes as well, that will then reconcile your 28% tax to your effective tax rate, which is what is actually shown in your income statement. Just so that you guys are aware of how that works. And then here I want to show a little bit more detail in your statement of cash flows under the cash flows from operations. This extract shows you a whole lot of detail in terms of what could be adjusted in terms of non-cash items or trading items to get to your cash flow from operations. So for example, here I can highlight depreciation and amortization. That's a non-cash entry. Impairment losses or reversal of impairment losses, non-cash entries. And these are all flowing through from your IFRS. Those are non-cash. Fair value gains and losses, non-cash. Adjustments for gains or losses on disposal of non-current assets, that's also non-cash. And that's just to give you an indication as to what could possibly come into your cash flow statement to get to your cash flows from operations, just so that you are aware of those and know where to look for them. Now you could ask, where do you go to from here? We've just looked at a very brief overview of how your financial statements work, how they are prepared, what to look out for. But where can I go from here to actually make it even more meaningful? Well, the one thing I would emphasize are management reports. Now, your management reports are most often prepared in a similar format to your financial statements and using the same financial reporting framework as your annual financial statements, except management reports are on a monthly basis. So all the things that we spoke about today, you can actually analyze and have a look at on a monthly basis, instead of only annually, where you might get a surprise or have to make large adjustments for accounting purposes. So it's a nice way to actually track your trends in your business and to keep an eye on what's going on in the step in ratio analysis. Now, ratio analysis is basically determining the statistics of your business. It highlights improvement areas. It could show you some red flags or strengths of your business. And importantly, there we need to go and look at it on a trend basis to see what is happening in our business. And this ratio analysis I'm not going to touch on in detail today, because it's completely an entire almost webinar on its own. But through ratio analysis in conjunction with your financial statements, you can get very meaningful information on your business and then use that for decision making. As I said, it's important also to analyze your financial statements as well as your ratio analysis in trends. So over a few years or across a few months, because to look at it on a kind of isolated basis will not give you very kind of accurate or effective information. And it's also important to remember that financial statements essentially are a historical view of your business, because it looks at what happened prior to that year-end date for the year. So you need to make sure that you take into account that information together with market conditions, industry conditions, best practices, and what is happening real time in the business right now in order to make decisions and, in other words, effective decision making. So I'm hoping that today's webinar will have added a little bit more comfort, a little bit more ease as to your starting point and how your financial statements can actually help you to get where you want to be in your business. We'd like to invite you to join us for our next webinar, which will be on the 25th of July in our normal time slot of 9 o'clock to 10 o'clock. And there we will be looking at unpacking the differences between an audit, an independent review, and a compilation in a lot more detail, whereas today I only touched on the introduction to that. If you have any questions, please feel free to send them through. Shane, if there are any questions coming through, please let me know. Thank you very much.